Hey there, Jason Taken, owner of Jaken Finance, back with another video. And in this video, I wanted to kind of go over the dangers of 100% financing on flip loans and concerns. Before we get into that, though, if you have any questions related to lending, short-term, long-term debt, go ahead and reach out to us. Our number is in the comments of this video, but you can also reach me at my cell right there. So here's a potential scenario. So there are, but before I criticize this, I want to say that 100% financing, it's great for experienced investors. It helps maintain liquidity. There are programs, even programs we have, where we can do it with a new investor, but I want to caution the attractiveness of the program with the concerns you can see, the concerns that we'll talk about here. So first things first, here's a hypothetical scenario. So you're buying the place for 150, you put 60 into it, and you think the ARV is worth 320. Okay. A typical loan program with 100% financing would be like 12% interest, so 1% per month. Maybe there's 3% in fees. It's likely more, but we'll say 3. And your all-in cost with these numbers before your carrying cost would be $216,300. Okay. Now I'm going to assume a hold time of 6 months. That means from closing on the front end to the sale or refinance on the back end, 6 months. You can call it conservative, whatever. So your carrying cost would be $12,600, and that's just your loan amount, which is $210 times 12% times 6 months. So your total cost of this deal is $228,900. That's 100% finance, assuming the payments are financed. Even if they're not, that's what you're investing into the deal. Okay, so assuming everything stays the course, your net on this is 91.1, and that's minus. I'm not including realtor fees. I'm just speaking specifically the loan. You can add realtor fees in if you want, but it doesn't add any value to this discussion. So what I want to do now is, because this, and the reason I'm bringing this up is because I'm seeing this more and more stuff come across us on the refinances. I'm seeing these types of scenarios. I'm seeing very high leverage front end deals where potentially the rehab took longer than the investor thought, and so now the cash out is not as attractive, right? So and for illustration purposes, I'll just talk about, let's assume your market has declined, right? So home prices are going for less than list, and let's assume, just conservatively, a 10% decline. So I just illustrated, I just did math here, but let's say it's 288 is your new ARV. A 10% decline. I don't know if you just noticed this, but you almost lost 30 grand in profit on the back end. $30,000 for a 10% decline. Okay, so that's one way the deal could be affected. So let's go back to 320. Now let's say it took you 8 months to get it, because once you get to the higher ARVs, properties are moving a little slower. Consumers are being priced out of the buying space, and let's also, winter comes along. So let's assume it's 8 months. Okay, so the monthly doesn't hurt you as bad. You dropped a few $1,000s. Okay, so let's assume 8 months, and let's assume a 10% decline. Okay, so 54. So that number was 91 grand, and now you're down to 54.9. Okay, that's a problem. Let's go back. Now let's assume, and again, this is all assuming that your ARV is correct, right? So let's assume a 15% decline, which is a number a lot of people are seeing. You went from 91,000 to 43,000. That's a $50,000 loss. Okay. Now this still had a pretty good spread. $100,000 spread is good, but I think flippers would concede that 100 grand spread or a 90 grand spread is not really what they shoot for, right? They're like in the $50,000-$60,000 range. So let's call it, let's go 270. Okay, so that would be your profit, right? You make 41 grand on a flip. A lot of flippers I talk to are happy with that. Now let's take that number and assume the 10% decline. Wow. And now we're not even calculating realtor fees. So hopefully this illustrates the issue and the concern with getting 100% financing on the front end. I'm not saying it's bad. I'm saying these are the concerns that are real. Math doesn't lie, and that you need to be mindful of when you've got someone who's willing to front you, 100% of the deal. So I'm sure this will catch some criticism. This is not targeted at people who know what they're doing and people who get it right. It is to highlight simple things that could make your deal go wrong. One more thing we could do here. So let's assume we targeted a $50,000 spread after cost, right? So this would be the number, right? Net on payoff, $50,000, and then we just look at a 10% decline. 23K, still no realtor fees involved, title costs, blah, blah, blah. You get it, right? So be cautious and make sure your numbers are very good before you embark on a front end flip, because what happens is if you can't pay it off, you're coming to that refinance or even that sale. And obviously if you're doing a refinance, there's no realtor fees, but you're coming to that. You could be coming to that sale with cash, which would be crazy. It'd defeat the whole purpose. So just be mindful of these. If you've experienced these, leave if your the platform that this video is on allows those things in the comments, go ahead and comment, criticize, whatever. And if you have a question, we do have 100% financing programs, but we look at it like this. And if there's enough spread to where we're pretty sure you can get out of our loan, we'll do it. And if you're a beginner, we're gonna critique the deal. Expect an in-depth look at your deal. If you have any questions, give me a call. See ya.